Hey, good morning, everyone. Good morning.
Good morning.
Hi, good morning, Yang. Well, how's everybody else? Good morning, Kazuki. Good morning. I don't know if your microphone, if your volume is on or not, but I saw the microphone icon light up. How's everybody else? No response from the rest of the class, only two
Good
Good
people?
morning,
morning.
Professor.
Hey, good morning, Angel. Good morning, Darlene. All righty, so I have six people, and let me check how many are there now. Looks like seven, right? Um, Looks like I have eight people, right? I have eight, so I should expect to see eight pretty soon. Okay, so that makes it seven, right? One more person, right? I think one more person. We are waiting for, I guess, still Leslin. Leslin is here, but not here, not in the collaborate. All right. So I believe you have. I believe you have noticed the new announcement, right, about quiz two, right? Everyone has. That was midterm. Everybody has noticed this.
That's
Yes.
right, yes.
Okay, good. Yeah, so it's gonna start tomorrow, ends on Saturday. So I mean, we'll have fully covered whatever is in the quiz two by Friday. I mean, by even Thursday. But so by Saturday you'll be able to do it. Anyway, by the main lecture we have already covered everything. And then on Saturday, there will be an announcement about the final. So you'll have these exams back to back. But the windows are back to back. If you, uh, you'll still, you'll have a couple of days apart, right? Depending on when you finish the quiz too. So anyway, so let's get started with today's. Now, we so we left the municipal bond out, uh, but this thing was covered already in the main lecture. So please refer to the main lecture. And also, I thought someone asked me after class yesterday about the past videos, and I thought I had already posted it there, but it wasn't posted. Uh, so it was there. I just didn't turn it on. Where is the? Oh yeah, this one was already there. I just forgot to turn it on. So you understand all the videos are there for 5 days. Um, that's usually what I do during the regular semester, um, so that the students wouldn't take too much time studying those videos. But if you miss, if those videos are already uh, not showing anymore, then you can always check them on my YouTube channel. Okay. I should change the name of my YouTube channel because it's just my name. Uh, but playlist, right? You can look it up by the playlist. You also have the playlist like this. Maybe it was Winter 22, not just W22, Winter 22. And Oh, with the space everywhere, space everywhere. So, but all the videos are there. If you think um, you cannot find the videos anymore, all you need to do is just simply go to, right? I mean, these videos are not visible to you anymore, but the live recording of the recording of these, the scheduled days class, it's there. And actually, yeah, this topic, I put yesterday's in topic 4, but I guess I better move it to, yeah, it's there, right? And somehow, why? Only one video here? That's not likely. Okay, so I'm not gonna go into municipal bonds. It's just about how we compare municipal bond with corporate bond, right? Because municipal bond is tax exempt, face value 5,000, and usually individuals do not buy municipal bonds. I mean, there's no law against it, but because of um, high face value, uh, of course the price would be something like $4,000, or even with 30 years left, it would still be like $3,000 or something. So it's very onerous. It's very burdensome for individual investors to buy municipal bonds. So mostly, it's the institutional investors that invest in municipal bonds because of relatively good return, and then tax exemption. This is a very important uh, feature of the municipal bonds. So when you compare the municipal bonds, you have to compare when you compare municipal bonds with regular bonds, taxable bonds, right? Corporate bonds, such as corporate bonds, you'll have to um, compare after-tax return of the corporate bond with the muni bonds. Otherwise, the comparison wouldn't be would be meaningless. So I'll leave it to uh, I'll leave it to you to study the main lecture videos about it. Now we will already understand a lot about the institutional aspect of the uh, bond, right? We already understand a lot about it, and so we'll go straight to the valuation. This session is being recorded, right? Yes. So we'll go straight to the valuation aspect. Valuation. So first, we know there are zero coupon bond and coupon bonds, and I told you zero coupon bonds generally sell with a full maturity of 30 years left, right? Usually, such zero coupon bonds sell at very deep discount. A typical case is U.S. savings bond, which is just a popular name for 30-year zero coupon treasury bond, and they generally sell for $500. But here, let's take a look at this example. Bond with par value of 1,000, maturing in 20 years. So of course, par value is always 1,000, right? Unless it is muni bond. Maturity left is 20 years. and price to yield 6%. This is the way it is worded. I mean, what this means is price to yield 6% means this is the discount rate. 6% is the discount rate. Okay? But you have to pay attention. You have to be careful about how it is worded, because they never say straightforward, use this as discount rate. Use 6% as discount. They never say it like that. The wording is never like that. The wording is always either the bond is priced to yield 6%, or similar bonds or comparable bonds, are yield 6%, or they are paying 6%. And in that context, what does similar bond mean or comparable bond mean? It means the bonds of the same risk class, right? Similar bonds, comparable bonds mean bonds of the same risk class. So the same triple B bond or same single A bond, or the third way it is worded, third way is the prevailing market rate is 6%, prevailing market rate. Now, prevailing market rate needs to be explained further, because previously we used the term prevailing market rate as just the going rate in the going rate of the bank interest rate. Okay, it can mean that too, but especially in the bond context, prevailing market rate means what the other bonds of the same risk class, in other words, the similar bonds, right, or comparable bonds, what the similar bonds of the same risk class, on average, pay, right? But the bonds of the same risk class pay on average. That's prevailing market rate. Okay, so there can be many different prevailing market rates, because there are many different risk classes in the bond. Okay, generally, between AAA to triple B. I mean, only triple B and above or investment grade. So then it says, it can be purchased for about 306. 306. How? They gave you the answer already. How did they come to this? Well, the way it is, think about it. This is a straightforward future value, present value relationship, right? In other words, 306 is the unknown, but this is the present value. This is the present value. But the others are given. This is the future value. Time, R, right? It's also called yield, right? 6% is called yield. So yield is another name for discount rate. So then we can easily solve for P, right? The present value is future value. So they did it this way. The future value is the face value in this case, right? Because $1,000 is the face value, and that's what you get in the future, at maturity. So it's called, it's the maturity value, face value, future value, redemption value. And then, so we discount it by 1 plus R raised to N. But here, something you have to remember is that you might wonder, oh, why is it then? Why is that? Isn't it 20? Why is it 3%? Isn't it 6%? No, what you have to remember is the bond is on a semi-annual cycle, right? This is zero coupon bond, but if it were a coupon bond, the coupons will be paid semi-annually, right? Therefore, although this is a zero coupon bond, it is discounted uh, uh, on semi-annual basis, right? So M is 2. Always for bonds, M is 2. So then we understand why it's 3%, why it is 40, 20 years, 40 semesters. So then it comes to 306. Okay. Again, this is called intrinsic value. Intrinsic value. This is not market price or book value. This is the intrinsic value. Okay, and in case of bond, the intrinsic value will be recorded as book value because there's no other basis for book value because unlike equity, unlike equity, it's not like I mean, I can't find the words to explain, but so I explained the difference between book value, intrinsic value, and the market price. Okay, and intrinsic value is also called rational price, rational, or fair value. Rational price, fair value, or intrinsic value, they mean the same thing. But market value would, can deviate from this because in the market, because of constant, fluctuation in demand and supply, the market price can deviate from this. But in case of bond, it can the ad hoc factor is minimal. In other words, ad hoc means something like random, right? Ah, I don't In other words, okay, that's Latin for ad hoc. It's something like unexpected or impromptu, right? Or random. In case of bond, ad hoc factors are minimal, right? So the market price won't deviate too much from the intrinsic value. So it's not difficult to value the zero coupon bond. Next, coupon bond. So let's take a look at this example. A bond has 10 years to maturity, a par value of $1,000, and a coupon rate of 10%. Okay, what cash flows are expected from the bond? Well, it's an interesting question because normally the question will be, what should be the price of the bond, or what should be the, how much should it sell for? But it's asking what cash flows are expected from the bond. So we all know 10 years to maturity, coupon rate of 10%. So that means annually you get 10% coupon. So $100 every year. Now in this example they assumed annual coupon, but you understand the bonds are on semi-annual cycle. So normally it would be $50 per semester, or every 6 months, over 20 semesters, right? So 20 payments of $50 coupons over 10 years, right? But then, just to simplify that, they used annual coupon assumption. So at the end of every year, at the end of each year, you get $100. Okay, and then at the end of the timeline, at the end of maturity, you get the face value of 1,000, or maturity value of 1,000, right? So now here we come to a conclusion. Oh, so to value this coupon bond, all we need to do is first find the present value of all these $100 cash flows, right? And then present value of 1,000, right? Does that make sense? And we are and what is the name for this type of cash flow? Anybody? You're getting 100 for 10 years at the end of each year. What kind of cash flow is this?
Is it a consistent one?
Say that again.
A consistent cash flow?
I can't barely hear you.
A consistent cash flow?
Oh yeah, a consistent cash flow. But then that's a description, not a name. It's a description. It's just a description, not a name.
The payment?
Yeah. But it's a payment. But this pattern, look at this pattern. What is this pattern called?
Annuity.
Annuity, yes. This is called annuity. Isn't that right? Regular amount.
Yes, yeah.
At regular interval, that's called annuity. Who was that? Who said that? Who said annuity?
I believe that was Ying.
Yeah? Ian. And okay, I heard, okay, Ian. Who said it was me? Someone said it was me, but I heard only one person. I heard only one voice saying annuity.
I said annuity.
I didn't say it was me. Ying said annuity.
Oh, okay. Okay. All right. So now we come to this conclusion, now to value the coupon bond, we need to find the present value of two types of cash flows. One is annuity, the other one is just single cash flow. So we need to find the present value of these, annuity, $100 annuities, and present value of 1,000 single cash flow, right? Yeah, it's an ordinary annuity. So the bond valuation formula consists of two components. One is the present value of annuities, which are coupon payments, right? Plus the present value of the single cash flow, the face value, right? So this is the formula for annuities, right? Instead of payment, I just replaced it with the term coupon because is coupon payment and the face value. So now it's not difficult. So here, let's take a look at this example. Consider a 20-year bond with 7% coupon. If the discount rate is 6% annually, right? So here, the question is then, what should be the price for it? What's the price of it? What's the price of this bond? Again, we're talking about the intrinsic value, not the market price. And uh, market price is something you can just look up. You can look up, the most recent, transaction, and that's the market price. But we don't want the market price because that market price can always change. It can change anytime, and that's not the true value. Now we can already tell. Oh, so it's 20 years, so there will be in the time there will be 40 payments, 40 coupon payments because it's semi-annual, and every time the coupon is $35, right? $35 because it's 7%, $70 a year, $35 semi-annually. Discount rate is 6%, so semi-annually 3%. Now from this, without doing anything, we can tell already, without calculating anything, without using any math, we can already tell whether this is going to be a discount bond or premium bond. Right? Isn't that right? We can already tell if this is going to be a premium bond or discount bond. Anyone?
Discount bond.
Discount bond? Why? Discount bond is what? I mean, what's the definition of discount bond?
The coupon interest rate is lower than the market interest rate.
Coupon rate is lower than the market rate?
Oh no, sorry, my fault. I think it's premium bond.
It's vice versa. Actually, the coupon rate is greater than the
The
discount rate.
Yes.
Now then, if that's the case, what's it going to be? We did this already, in topic 1. We did why is the bond becoming a discount bond? Why is it becoming a premium bond, or et cetera, right? And why? Come on, nobody can answer that?
Because
The rule was,
because of the fluctuation.
because of the fluctuation. What? Because of fluctuation, what? I mean, what's your conclusion? My question was, is it going to be a premium bond or discount bond? Then the answer is only either a premium bond or discount bond.
Premium.
Yes, it's going to be a premium bond. But for that answer, I cannot give you a point, right? Because think about it. It's either discount bond or premium bond. You said discount bond previously, and if that's no, then the only other option is premium bond, right? So, we already did this in topic 1. 3 possibilities. I'll call it yield now, right? Previously, I used R, rate, but this is the coupon rate. There are 3 possibilities, right? 3 possibilities. Aren't there? Either coupon rate is greater than the discount rate, or yield, or less than yield, greater than yield, or equal to each other. But then think about it. If this is the case, then it's going to be a premium bond. This is the case, it's going to be a discount bond, right? And the reason being, and a simple rationale is it's not even mathematical logic, it's just logic. This is what this is what the similar bonds pay on average, right? The bonds of the comparable bonds of the same risk class pay on average. Okay, and this bond is paying higher coupon, then the demand for this bond will go up, so the price will go up, right? It will go up above its par value of 1,000. And if it is the other way around, right? If it pays less than the average or the prevailing market rate, then the demand for this bond will go down, price will drop, and will sell at discount, right? So we can tell already from this that where was I? This is going to be a premium bond because coupon rate is 7%, discount rate is 6%. And here, I've been telling you, this is not the way it is worded normally. Okay, this is not the way it is worded. So don't expect this type of wording. They never tell you discount rate is 6%, right? It will say always it's price to yield 6%, or comparable bonds are paying 6%, or prevailing market rate is 6%. So then we just plug it into our formula, right? And here it looks quite complicated. And I don't, but it's just a variant. It's just a variant of this formula. It's just a variant of this formula. Okay, it's just a variant of this formula, right? Looks complicated, but look, I wouldn't use this because this is, look at the annuity part. They factored out the coupon payment, and then like, three-story building, I mean, three-story fraction, that is unnecessary. But anyway, if you do that, you will come to $1,115.57, which is clearly premium bond, right? Which is clearly premium bond. And, most of its value comes from the coupon, because the coupon is, this is a 10%, a 7% coupon, which is, if it is 10%, of course, it would be more, $1,000 discounted 20 years, right? 40 semesters will be only 306. But the value of the bond is, if it is especially long-term bond, like 20 years, 30 years, the value of it is derived mostly from its coupon payment. So let's take a look at the next example, determining rational price or intrinsic value of the bond. Let's take a look at this. The Emory Corporation issued an 8% 25-year bond 15 years ago. And it was issued, it has the timeline of 20 years, but that was 15 years ago. So what does that mean? 25 year, 15 years ago. Now it has only 10 years left, right? Isn't that right? Coupon is 8%. At the time of the issue, it sold for its par value of 1,000. So from this, what can you tell? At the time of issue, it sold for its par value of 1,000. I mean, we can tell something about the prevailing rate in the market at the time. In other words, 15 years ago, what do you think the discount rate was? Anyone? 15 years ago,
10%.
huh? 15 years ago, it sold at its par value of 1,000. So then, what can you say about its the yield or the prevailing rate at the time?
10,
Anyone?
10,
Huh? 10%? Why is it 10%? It says comparable bonds are yielding 10% today. It is 10% today, but 15 years ago, what should have been the yield?
We do not know.
We know. Yes, of course we know. You forgot already? 3 possibilities?
Oh, it's in the middle one, right?
Yes, of course, it will be the middle one. If this is greater, coupon rate is greater, then it's going to be a premium bond. Coupon rate is less, then it's going to be a discount bond. If they are equal, then it must sell at par value. It should sell. Why? Think about it. Investors will be indifferent between this bond and other bonds of the same risk class. Right? You understand? Indifferent. You know what indifferent means? Hmm? Of course, people know what but indifferent means it doesn't matter, isn't it right? Hmm? When someone says, I'm indifferent, I mean, or someone says, people generally don't say like that, but if you say, oh, he was indifferent between this and that, he was indifferent, that means he's not interested. Or if you're not interested, does it matter whether it is this bond X or bond Y? Right? In economics, indifferent means it doesn't matter. Right? When when a consumer or an individual is indifferent, right? That means whoever is it's like I'm indifferent between Coke and Pepsi. That means doesn't matter whether it's Coke or Pepsi. It doesn't matter, right? Um, and usually in microeconomics context, um, that's what when in a perfect competition, all the producers are basically small and not significant, insignificant and small, and not significantly different from one another. And the products that they are making are not significantly different, so they are all homogeneous. Think about it. Paperclip or rubber band. Think about it. Those things. I mean, is any paperclip particularly better than another paperclip by another manufacturer? You don't even recognize the brand name of you don't care, isn't it right? You don't even recognize the manufacturer's brand name. Which company made this? Doesn't matter. It's just a paper clip. No matter who made it, a paperclip is a paperclip. It doesn't do anything significantly different from another brand. Does that make sense? Hmm? Rubber band, the same thing. Doesn't matter which rubber band. Rubber band is just a rubber band. They are all just homogeneous goods. Do you particularly remember or recognize any particular rubber band manufacturer or paperclip manufacturer? You wouldn't. Why? Because you are indifferent. Okay? You're indifferent. So it's the same thing. If the coupon rate is equal to the prevailing market rate, which is the yield, right? Which is the average of what other bonds of the same risk class are paying, then you will be indifferent. Then there's no reason for the price of the bond to go up or to go down, right? Because nobody prefers this bond, right? Or nobody despises this bond or makes uh, little of this bond. It will be so it will sell for par. So then that's why you can tell, at the time of the issue it sold for its par value. Then at the time of the issue the discount rate was also 8%, right? Does that make sense, everyone?
Yes.
Okay, only one person.
Yes, sir.
Okay,
Yeah.
good. Kyle and Randy. Other
Yes,
people are
Professor.
completely okay. Leslie, is it my? I'm sorry. It must be my. No wonder why it was so. I'm sorry about that. My volume that was low. Okay, and then and then today comparable bonds are yielding 10%. So then now we can tell whether this is going to be a premium bond or discount bond. Is it going to be a premium bond or discount bond today?
Discount.
Discount bond, yes, of course, because the discount rate is 10%, but the coupon is 8%. So, yeah, I already calculated it there. That's going to be the price of the bond. It's clearly a discount bond, but we're going to actually calculate that. Assume the bond pays interest semi-annually. Also calculate the bond's current yield. Now I'm going to get to the current yield, yield to maturity and current yield. So everyone, I want you to go to this file. That's something you will find already, here. Did I go to this Excel file, right? Please download it. Please download it and have it, open it in front of you. And do you see all the blanks? The highlighted cells must be blank. Do you see it? Are the
No.
highlighted cells? No? Are they filled in?
Yes.
That's weird. So please delete it. I don't know why. Okay. Let me close this. Download it again. I thought well, it's blank. What do you mean it's filled in, isn't it? Are those highlighted cells, are they blank or filled in? I just downloaded it and it's blank.
Maybe I downloaded a few days ago, so that is.
Oh, previous. Okay. Then please delete all the highlighted cells. Please delete. How about everybody else? How about everybody else?
Correct, right?
It's blank, right? You don't have the highlighted cells are not filled in. Is that right?
Right, right.
Okay. All righty. So then let's do that problem, which is, I think I will need to make slight adjustment here. And I would call this, normally, I use the, okay, no big deal. I'm gonna do this. So where am I? 8% current, okay, coupon 8% and 10 years left. Let's use this. Coupon rate is 8%, so we change that to 8. Time left 10 years. APR, which is yield, right? Yield is the discount rate, right? And I will change this to normally I use B for rational price of the bond and P sub B for market price of the bond. So we have everything set up. Coupon rate. This is the coupon payment. So we know coupon payment is that divided by M. Okay? $40 every 6 months. And N is 20, we all know, because it's 10 times 2. Right? And yield is 10%, but that means half your rate. Half your rate is 5%. Okay, let's find the price of the bond. So I think I was using this already. But that's okay. Doesn't matter. So all we need to do is first, present value of annuities, which is payment over R minus payment over R times 1 plus R is to N. Okay, here I made a mistake. That is, parenthesis. Right? This is only the coupons, right? Present value of all those coupons. Plus the present value of the maturity, right? Maturity value. That divided by 1 plus R is to N. Okay, there you go. You hit enter. Okay, hit enter. Something. Yeah. Yes, let's see. No. This is wrong. Payment over R payment over R times 1 plus R raised to N. I didn't close this. Forgot to close that. Okay, so it's always very important to close parenthesis So we hit enter. There you go. This is the rational price of the bond. Okay. And as predicted, this is a discount bond, right? So everyone is okay with this? Everyone? Everyone
Yeah.
with this? Okay,
Right.
good. You got this. All right, you're good. Our next question. So what is the current yield? So current yield, so here's the thing. Bond, I've been calling the discount rate yield. So what is yield is, and oh, where did I put yield? Okay. Now, there are two types of yield, yield to maturity, and current yield. Yield to maturity is basically, they call it long-term yield. And I've been telling you, yield is annualized return. And it's different from the interest rate, because yield, remember in house value example, right? In house value example, um, the return must include capital gains and cash flow, right? So bond is just like the scenario two in house value example. Stock as well, but in case of stock, dividend is irregular, right? Bond, in case of bond, interest is regular. It's an annuity, right? So it's just like scenario two of the house example. And then think about it. There are two components when we calculated return, capital gains and the cash flow, which is the rental income at the time. Think about it. In case of bond, the coupon payment is like rental income. Coupon is like rental income. And then the bond will have, if it is a bond, will have capital gains or capital loss. If it is a discount bond, there will be a capital gain over the life of the bond, right? Think about it. You paid, 8 something, 875, 857, whatever. And then 10 years later, you'll receive 1,000. So there's a capital gain. But if it's a premium bond, there will be a capital loss over the life of the bond. Does that make sense? Mm-hmm. So it's like, I don't like this. But this is the timeline, right? This is the maturity. Time 0, right? I'll put it here, maturity. And if the bond a discount bond sells below par value, right? $1,000 par value, and so at maturity you get 1,000, right? And it sells below par value, so that's why. And as time goes by, right? And maturity is 1,000, right? So it's like this. right? So then clearly capital loss and capital gains. Maybe I should have used, I'll just continue. And then a premium bond over the life of the bond. This happens. So what is that? Capital loss, right? Then think about it. Discount bond will have positive capital gains plus coupons, right? Therefore, it will have higher yield, higher return, right? Uh, higher holding period return. Holding period return will go up, right? Go up, or higher than the others. This is negative, right? This is negative, right? Clearly, it's negative. Coupon. This is positive. Obviously, positive, negative, right? The holding period return will go down. Make sense? Now, if you annualize this, right? That's called yield. Okay? That's yield. All right? Or yield to maturity, right? So yield to maturity is basically, annualized yield until maturity. Of course, if you hold it until maturity, right? If you hold it until maturity. And of course, every time the coupon is paid, it will change because remaining coupons go down, right? Remaining coupons go down. So obviously, and 1 year later, the price will be here. 1 year later, price will be here, right? 1 year later, 2 years later, price will be here, right? So of course, inputs change, so it will change, right? That's why they call it long-term yield, right? And it is also current market yield on comparable bonds. So that's what the average that's also what other bonds pay on average. So then you might wonder, does it have to depend on other comparable bonds? Does it have to depend on comparable bonds? I mean, can we, okay, based on this, can we not calculate, first of all, think about it. To yield is to calculate yield. Think about it. Everything else must be known. In other words, back to this bond pricing formula, right? Back to this. raised to n plus 1 plus r raised to n. Now, and let me now, what's the difference? What's the difference? Isn't it the same formula? Isn't that the same formula, except that, in the left-hand side, I use the symbol B, but here it is, P sub B. And here it's R, but here it's Y. Why different notation? I mean, is there a meaning to that difference? Yes, there is. Now think about it. In the first equation, this is the unknown, right? The price of the bond is unknown because this is the rational price, fair value, intrinsic value. Intrinsic value is unknown. That's why we are solving for it. That's why we are solving for that intrinsic value. But to solve for that, then everything else must be known, right? This is known, this is known, this is known, right? Everything else must be known. This is known, right? They are all known. And this is the unknown. But then, in the second equation, what is P sub B? I already defined what P sub B is. I said P sub B is the market price of the bond, market price. I use B as the symbol for rational price or intrinsic value, whereas I use P sub B as the market price. Market price is something you can look up. Market price is what you don't solve for. It's not what you solve for. Market price is not what you solve for. It's given. You look it up, right? And then what is the unknown in this case then? This is the unknown, right? The discount rate is the unknown. You understand? Once the bond is given, we know it's coupon payment because every bond, it's called indenture, the bond contract. It states what the interest rate is. So this is known. Payment is known. And face value is known. Time to maturity is known. Everything else is known. But what's unknown is this. The discount rate. And then think about it. There can be only one number. Logically, there can be only one value that will satisfy this equation. You understand? Meaning, there can be only one number, one value that can satisfy this equality between left-hand side and the right-hand side. Only one number, right? There can be only one value that can satisfy this equation. That number is called internal rate of return. Internal rate of return. So yield is actually half-year yield, right? It's half-year yield, half-year yield, right? Half-year yield is the that one number, right? That makes the left-hand side equal to the right-hand side, and if we find a number, that is called yield, internal rate of return, and yield is the internal rate of return. And then think about it. The only way that can happen is and although they say this is what the other bonds are paying on average, but mathematically, that average must be internal return, because this may not be the true average of the true average of the bonds of the same risk class, but it's just defined like that. But the point is, this is why it is called. Remember, I said the wording. They never say directly that this is the discount rate. But I said the wording is that something is the bond is priced to yield 6%. That means if this is 6%, you get the market price. That's what it's saying. So that's okay. We've gone too long. I mean, what time is it? It's 1:10 already. So I must take a break at this point. We'll take a 10-minute, and when we come back, then I'm gonna go into current yield is very easy. It's nothing. So let me put you. Okay, where is it? Okay, let's take a 10-minute break. Okay, 10 minutes. All right, we're back. We're back. So, so now, I'm sorry. Still need to talk about the current yield. Now, current yield is a short-term yield, right? Remember, yield to maturity is what they call long-term yield. It doesn't mean really, it doesn't mean, a holding period return, but, annualized return for a long term, right? For long holding period. And the current yield is short-term return, meaning, what is short-term? Short-term is always in finance and accounting, the line between the short-term and long-term is uh, drawn exactly on 1 year. So short-term return means return for uh, under 1 year, but 1 year, literally 1 year. Why? Because all the returns are annualized. Then think about it. Um, the maximum you can earn from a bond, the maximum you can earn from a bond is what do I use? Okay, current yield. What is the maximum you can earn from a bond for holding it for 1 year? Hmm? Anyone? What's the maximum you can earn from a bond for holding it for 1 year?
The interest income?
Yeah, the interest income. In other words, annual, right? Annual coupon payment. Isn't that right? The maximum you can earn uh, within 1 year is the annual coupon, right? And when you calculate return, you'll have to divide it by the price you paid. And the price you paid is the market price. Isn't it right? The price you paid is the market price. Um, you cannot, there's no other way. I mean, no matter how irrational the market price is, if you want to buy something, you have to give them the market price. Isn't that right? Um, I'm kind of I don't buy anything uh, if it is not to my liking. If the price is not to my liking, I don't buy it. So, but then, um, you have only two choices. Either you give it up, you don't buy it, or you wait until the price comes down to the price that you like. The market price is usually, think about it. I don't like to pay like $2,000 or $1,500 for iPhone 13 or whatever. Uh, or I don't like to pay because I know it's overpriced. That's not the intrinsic value of iPhone 13. Of course, Galaxy Z Fold, the foldable phone. In South Korea, they have a big foldable phone. I mean, Galaxy Z is just foldable. But when it's like 8-inch screen, 10-inch screen. I don't know, but when it's folded, it becomes it just falls into the size that fits into your palm. But then they have also a larger foldable phone, and it's very fancy. I would like to have that, but the price is what? I don't know what the price is. I haven't, but if the price is something like $2,000, $1,500, I'm not paying that price. I'm not going to buy that. Oh, because if I don't, then I can two choices. I can live without it. I should live without it, or I have to succumb to that price. I have to I have to surrender to my crave for that. And they have even three threefold. It folds three times, not just foldable once, but but if I always wonder, what is the intrinsic value? What's the intrinsic value I'm talking about here is, the cost of material, cost of labor, cost of, but then again, cost of capital that went into it. Uh, and there was a very, um, very well known, very popular, or very uh, very well watched video years ago. There was on internet, which was about the true manufacturing cost of iPhone. And parts, they were just about, the most expensive part was not more than like $40. So the total comes to only about, like, not even $100, right? But then that's only the price of the parts, right? I think it was like $80 or $90 but then uh, what about the labor? Yeah, but then it's produced. iPhone is made in China most of the times, or in Vietnam, or of course, uh, the wages in China have increased. It wasn't like before, but even back in 2010, when like early iPhone models came out, they were still sweatshopping. They paid like $2 a day, right? The wage was like $2 a day. And then, so wage, very immaterial in calculating the intrinsic value. Next question is, how do you put monetary value on the technology? Monetary value on the technology. Well, let's say, okay, uh, maybe $100 for the technology is a reasonable value, or $200. But in total, it shouldn't come to more than $300, or but the iPhone was selling for like 600, 800, $1,000. So I never liked iPhone. I never liked any Apple product. Although I'm Apple shareholder, I don't like Apple products. They say it's more design is more sophisticated, or more uh, uh, what do you call, user friendly, or no, I don't find it user friendly. Or I mean, Galaxy is as beautiful and user friendly, or Dell computer is for me more user friendly than I mean, this is my personal opinion. So I don't buy it. If the price is like, price of iPhone was probably $200, I wouldn't mind. But I will still be indifferent between, Galaxy and iPhone. And now, Galaxy Z Fold or something. I don't know if you've seen it, Z Fold. If it is going for like $1,000, I'm not buying it. Let's see, what's it like? Galaxy Z Fold. Uh,
They're like 1800, the Z Folds.
oh, is that? Thank you. Galaxy. I'm not gonna buy it. I'm not buying it. Huh? Z Fold. Yeah, 1,000, almost 900. Um, I'm not buying it. And the reason is, as I said, that's not the intrinsic value. Intrinsic value would be, again, the big question is, how do you put the numerical monetary value on the technology. But still, even with I love the technology of Z Fold, but I'm not willing to pay $1,900, right? But if I succumb to that, if I succumb to my craving for Galaxy Z Fold 3 or whatever, I will have to pay the market price. There's no other way. Isn't that right? That's what the market price is. So if I pay the market price, the maximum I can earn in the short term, right, is annual coupon payment. That's what the coupon current yield is. Okay, so yield to maturity versus current yield. Okay, now it took a lot of time to explain this. I mean, I took a uh, I, I took a winding path, or I digressed a lot. So let's get back to. So next question was, what would be the current yield? Current yield is, now this is the intrinsic value, but we don't know what market price is. But I've been telling you, in case of bond, the market price of the bond isn't that much different from the intrinsic value because there aren't that many unexpected variables in pricing it, right? There are no ad hoc variables, in bond valuation. And if the bond is correctly priced, I use ad hoc. Yeah, there aren't that many ad hoc factors. So if the bond is correctly priced, then the market price would be also this, and hence that's why I used PB there previously. Price of subscript. Okay. Then current yield, simply what is the maximum? $80, which is which you can do by simply a times that divided by this, to 9.14. Now 9.14 is clearly lower than the yield to maturity in this case, because the longer you have it, the greater the return will be. I mean, if you have it just for 1 year, that return cannot be as high as 10%, right? All right. So that's how we do the do that example. Okay. And we're gonna next call. I don't know if I should do the call here or later. Okay. Call provisions. Call is a right to buy, actually. So here's the thing. Call is actually a term that comes from the stock market, because in the stock market there are options, futures, and just straightforward there's a stock, and there is an underlying, a stock is an underlying asset, and there are derivatives from the stock, derivatives. Derivatives are instruments that are derived from the underlying asset. the underlying asset is stock. And typical case of derivative is options and futures. Futures and options. Futures, futures market, it's delivery, the price of the contract that will be delivered in the future, the contract of the stock to be delivered in the future, futures market. And then there are options. Options are basically a right to buy or sell the stock when it meets certain conditions. So there are two types of options, call and put. So call is the right to buy the stock at a specified, pre-specified price. Put is the right to sell at a pre-specified price. So what does that mean? Why do we need, put and call? So it's like this. Suppose you want to buy Apple or Microsoft, I don't. Suppose you want to buy Apple, and Apple is currently price of Apple is currently, let's say, how much is Apple? I haven't checked recently, but let's just to make sure, just to make it simple, currently $200. Let's say Apple is currently $200. You think this is overpriced? Oh, we all know if something is overpriced, right? That is a sell target. If something is underpriced or undervalued, that's the buy target. And that's why we are trying to find intrinsic value, right? Remember, the bond valuation formula, we do this we want to find this is intrinsic value, I told you, and this is market price. P sub B is market price. And why do we want intrinsic value? So that we would know if it is currently, right? We want to know if the market price is currently like this or like this. In other words, if it is like this, that means what? Market price is undervalued. Market is undervaluing is true rational price. So then what? If the market price is undervalued, that means sooner or later, right, there will be an upward correction. Correction, they use the term correction normally for downward correction. But think about it. If this is rational price or intrinsic value, that's what it is, intrinsically worth. That's what it is intrinsically worth. And then, but it's selling below that intrinsic value. Then what would you do? I mean, the market will notice that this thing is undervalued, and sooner or later the price will go up. There will be a price correction. Now think about it. If you can find any, okay, Galaxy Z Fold. Let's say intrinsic value of Galaxy Z Fold is $1,000. Intrinsic value is $1,000. Currently, it's selling for $1,900, so it's more like this. It's overvalued. But there's no other way. You have to, if you want that phone, you'll have to pay $1,900, $1,800. But if you ever find, okay, the intrinsic value is so 1,000. But if you ever find any, by some fluke, or by luck, or by fluke, if you find a place where they sell Galaxy Z Fold for $500, aren't you gonna buy that? Huh? Why? Because the price is, the intrinsic value is 1,000, and if ever you find a place where they sell it for 500, this is, an opportunity to buy not only cheap, but there must be some mistake in their store. There must be some mistake in their store because for whatever reason, there must be some mistake in their store. And as soon as they realize that mistake, as soon as they realize that error, the price will go back up to 1,000. So before the price goes back up to 1,000, while there is still the window of opportunity open, you will buy that. Not only, you won't buy only one, you will buy 2, 3, 4, 5. You'll buy more than one, because at least you can keep one yourself, and you can resell it for at least, like $1,000 or $900. You'll still make money, right? So that's the window of opportunity. If anything is undervalued, which means below its intrinsic value, then that's a buy target. And sooner or later, the price will go back up to 1,000. It's not only because they realize that they made a mistake, but also not only you, but others will also find out about this. It's not only you. If you found out about this store where they sell it for 500, right? Others will find it too. Then what's going to happen? They will all run to this store. They will all run to this store trying to buy this phone for $500. And sooner or later, the price will, what's going to happen to the price? Anyone? What's going to happen to the price? Did everyone hear me?
Yes.
Yeah, but then, why no response? I see like, 8 people and just one response. But think about it. If everybody finds out about this price, then they will all run to this store and they want to buy this. And what's going to happen to the price? The price will go up, right? Isn't that right?
The demand is high, so the price is...
Exactly. Because of the strong demand, the price will have to go up. I mean, the store owner doesn't have to realize that they made a mistake. Store owner doesn't need to realize it. When the buyers run to their store in droves by tons and then want to buy, the price will have to go up. And then the price will go up until what? When? The price will go up until it reaches... The price will go up until it reaches 1K. And at that point, the buyers will be indifferent. You understand now? The buyers will be indifferent because it doesn't matter whether they buy it from the store or from anywhere else. There's no incentive anymore to buy from here. So the strong demand pushes up the price, drives out the incentive to buy. The price will be equalized then, and with any other places, anywhere else. The price will be equalized with the price anywhere else. Right? That's what happens. When something is undervalued, eventually there will be an upward price correction. There will be an upward price correction. Right? Does that make sense? That's why it's a buy target. And that's why you want to find intrinsic value. And the opposite is true. Think about it. If the 1K is the intrinsic value of that Galaxy Z Fold, currently this is selling for 15K. What's going to happen? Nobody wants to buy it because they can buy it for 1K somewhere else. So what's going to happen? The price will drop, right? The price will have to drop until the price drops to 1K again. Then they will see buyers coming back, right? So that's overvalued. That's the case when it is overvalued, right? Then when the price is overvalued, right, the market price is overvalued, then there will be a downward correction, downward. It's just, a simple law of the demand, law of demand. Okay, so I forgot why I came to this one, but yeah, because I was talking about call and put options, right? So currently Apple is, if the price of Apple is $200 and you think it is overvalued, right? You think this is overvalued. That means you think there will be a downward price correction, and you believe 150 is the intrinsic value. That's the fair value, you think. So you want to wait. You want to wait until the price falls to 150. But what if it doesn't fall? What if it doesn't fall, but it still goes, what if it still keeps going up? If it keeps going up to 250, not K, 250, you're going to regret. You're going to regret not having bought it at 200. Right? You're going to regret not having bought it at 200. So that's what happens, quite all of the time. So what do? You buy then. You're betting that the price will fall, but you want to cover yourself for the possibility that the price will continue to go up. So in that case, what you do is you buy call option. Call option. So let's say you buy a call option. And the price of the call option is, let's say, $10. $10. Of course, the transaction happens by lot, not just by, I've been telling you, stocks trade by even lots. Lot means, order for 100 shares. So the call price is also based on the lot, not, by. But anyway, the point is, if you buy a call option and you have a strike price, you can strike price or exercise price. And let's say that exercise price is, just to make it simple, just 200. I mean, oh, I mean, 210. Let's say 210. Because currently it is 200. Exercise price is 210, and it gives you the right to buy the stock for 200. Okay. So what that means is, if the stock currently is selling for 200, is trading for $200, but you are hoping that it's going to come down, it's going to go down, but there's a chance that it can also go up. If it goes up, you will regret not having bought it when it was 200, right? So to cover for that upward risk, right? To cover for that risk of the price going above 200, you buy a call option, paying $10 per share, and then if the price goes, above, price keeps going up, right? Then you can, let's say, at 210, which is the what they call exercise price or strike price, you can exercise this option and then buy for 200, right? So even if it is 250, even if the price goes up to 250, 300, you can still exercise it and buy for 200. Okay, does that make sense? And then if the price drops, you don't have to exercise the option. You'll just let it expire. I mean, the options have expiration date. You don't exercise it. You just let it expire. Because if the price drops to 150, I mean, even when the price drops to 190, think about it. If the price drops to 190, right, you can buy cheaper than 200, right? You can buy cheaper than 200, and with $10 that you paid, you're paying exactly 200. I mean, if it drops to 150, you're paying actually 160, right? Because you paid 10 for the call option. So that way, option is literally, think about it. The word option means it's a choice. You can either exercise it or not. You have an option to exercise it or not. If you don't exercise it, it will just expire. It will just expire unexercised. And if you exercise it, that means the price went up, right? That means price went above like 210. The reason your exercise, think about it. If the strike price is 210, that means If the price goes up, if the price goes up, you will exercise it. The cost to you is exactly if the price is 210, you just broke even, right? If the price is 210, you just broke even, because you will get the stock delivered to you for $200, and you paid $10 for the stock option, for the call option. So if the strike price is 210, then you just broke even. Okay, so call is an option to buy at a specified price when the price goes up. Put, on the other hand, put is the option to sell at a pre-specified price. I'm not going to go into put at this point because it's going to take a lot of time. The point is, what does it have to do with the bond? What does it have to do with the bond? Think about it. In case of bond, if you are the company, if you are the bond issuer, not the bond holder, but the bond issuer. Bond issuer is the borrower, isn't it right? Bond issuer is the borrower. So bond issuer sold, $10 million worth of bond. They sold. So that means their debt is 10 million. Suppose this is a 10-year bond, 10-year. And then what's your coupon rate? At 10%. 10%, right? Think about it. Every year you will have to pay $1 million as interest for 10 years. And this 10% interest rate is, a huge burden. But when you sold the bond, the coupon rate had to be, you had to set, 10% coupon rate because this was either, greater than or roughly, let's say, equal to and at the time when it was first issued, the prevailing rate in the market was, let's say, 10% or something, okay, not 10%, but something less than the coupon rate or close to the coupon rate. Okay. Now think about it. If you're not paying at least something that the market average, if you're not paying something like market average or better, the chances of selling the bond would be very low. So you sold it at the time at 10% coupon rate. But as time goes by, think about it. A couple of years have passed. Let's say like 3 years later. 3 years later. The prevailing market rate went down to 5%, let's say. Let's say 3% even, right? The prevailing market rate went down to 3%. Now think about it. At the time, at time zero, right? At the time of issuing, prevailing market rate was something like 10% or 9% or 8%. So they had to pay at least 10%. 3 years later, it went down to 3%. Don't you think they want to, I mean, do you think they want to continue to pay 10% still for the remaining 7 years? Do you understand? Do I have to write it down? Rather be happy.
I would like to say no.
Huh?
But I would like to
Someone
say
says something?
I said, personally, I would like to say
I can barely hear you. Are you speaking to me?
no. Yeah, I was just saying, I don't think anybody would be happy.
Yeah, the volume is low, but I think he's saying they would not want to pay that.
Exactly. Yes. I mean, logically, think about it. When you want to be happy to still pay 10% if possible, you want to, because currently the prevailing market rate is 3%. Prevailing market rate is 3%. So if possible, you would like to lower your interest burden. Isn't that right? You would like to lower your interest burden. So then, what would you do? If it is possible,
Retire
you want,
it. Retire it and buy new one.
okay, retire is not, okay, retire is not the right word, because retiring the bond means you are fully, yeah, retire. I'm sorry, it's not that wrong. I mean, yeah, you want to retire the bond. In other words, you want to recall the bond. You want to recall. You understand? You want to recall the bond. But you cannot recall the bond unless it is a callable bond. Unless it was a call bond, you cannot recall the bond. Think about it. If you can recall the bond anytime at your whim and at your will, then what is the bondholder? I mean, I'm the bondholder and I'm the lender. I bought this bond because they promised to pay 10% for 10 years. But suddenly in year 4 or in year 3, they want to recall the bond. You might say, well, what's the big deal? I mean, if they recall, I will get my money back. In other words, I will get the full face value, $1,000, full face value, and I will get the full face value. What do I have to lose? You will be losing 10% interest for the remaining 7 years. Why? Because when overall interest rate in the market went down to 3%, then that means throughout the entire market, throughout the entire economy, that 10% interest rate, it is nowhere to be found anymore. Overall interest rate all went down. So then you will be losing that opportunity to earn 10% for the remaining 7 years. Okay, so from the bondholder's perspective, no, they don't want it. But then, so it is only possible if it is callable bond, and then calling the bond means they will have to pay off, right? If they call the bond, they will have to pay off the maturity value, the face value of plus 1 year coupon, which is like a penalty. Okay, 1 year coupon as penalty. But if it is only callable bond, if it is not callable bond, then you can't do it. You can't do it. The reason it is called call is because it's exactly the same concept as the call in the stock market. It's the right in the stock market. It's the right to buy. It's the right to buy. But in the bond market, it's the right to recall the bond. But then here's the thing. Think about it. It's gonna if it is a callable bond, and if they another thing it is like the call is, it's an option. Option means you can either exercise it or not exercise it. So you will exercise it. You will exercise it if the interest rate falls. Only if the interest rate falls. If the interest rate doesn't fall, there's no reason to exercise it. Or even if the interest rate goes up, overall interest rate in the market goes up, there's no reason to exercise it. Does that make sense? Huh? God, it's already like I should have taken a break, but we'll just keep going because it's already 2:07. So again, the reason it's an option, it's a call, like a call option in stock. You exercise it when it meets certain conditions, and in the bond, that certain condition means interest rate going down. And interesting thing is, okay, then they will have to pay back. So let's say in year 4 they called the bond. In year 4, they called the bond, and then that means they will have to cough up $10 million plus 1 year coupon, which is 1 million, right? Coupon rate was 10%. Coupon, you remember? Coupon rate was 10%. 10%. So as penalty, it's called call premium. Call premium is penalty. 10% of 10 million. So it's 11 million. And you think, if they want to, so the thing is, they call the bonds, and the reason they do this is to save on the interest, because they want to pay off the old. They want to recall the bond. That means they will have to pay out this 11 million, but then they can borrow another 11 million or 10 million at something like 5% interest rate, something that's slightly better than the prevailing market rate of 3%. Even if they borrow 10 million at 5% for the remaining 7 years, or the next 10 years, another 10 years, interest burden is much lower, right? So they do this. And if you think about it, this is what they call refinancing. This is nothing but refinancing. What is refinancing? Refinancing is basically what you do when you have a loan like mortgage, and when you have a 30-year mortgage, and when you took out the mortgage, overall interest rate in the market was high. So your rate was 10%, which is huge, of course. But now overall interest rate in the so you've been paying 10% interest rate for the last 10 years. With 20 years left in your mortgage, overall interest rate in the market went down. So then your rate will also, your rate goes down too, but not the rate on this existing mortgage, because it's a contract. You still keep paying 10%, and you don't want that. Now you can do better, because overall interest rate in the market went down. You can probably refinance, you can borrow, right, at let's say 5%. And if that's possible, why not? Why wouldn't you do that? And it's called so you do that. That's called refinancing. But in refinancing, actually, so think about it. In this case, this company you think, this company will have to cough up this 11 million out of their own pocket. No, they don't have to cough up out of their own pocket. What they do is before refinancing, they simply, before call, they simply sell new bonds, new round of bonds for, let's say, 11 million. 11. And so they get they have cash inflow of 11 million when they sell it. With this 11 million, they simply pay off the old bondholders. They call and they pay off 11 million. So in other words, you don't have to dig into your own pocket. You don't have to use your own money. You just use the money of the new lenders. Right? Does that make sense? Because you're the borrower, the company is the borrower, and the company will simply refinance it with, they will pay off the old bondholders with the money from the new bondholders. Okay? I know some people might say, oh, it sounds like a Ponzi scheme. No, it's not Ponzi scheme, because I'm gonna, in Ponzi scheme, there's no growth. But you can consider this as rolling over your debt. But again, this is what happens a lot in personal finance when they say refinancing. If you think about it, that's what it is. Did you ever get any mail from a bank, the balance transfer? And commonly, it's called balance transfer. Did you ever get a mail offer, a balance transfer offer from a bank? Has anybody ever got a balance transfer offer
No.
from a credit card? Yes, someone has? Huh? Yeah, what is that? What is balance transfer? What's the balance transfer offer? It's basically, oh, do you have $10,000 on your credit card balance? Are you paying what? And are you paying 14%, 50% on your credit card? Now use this balance transfer opportunity and pay off your old credit card company and say goodbye to 15% interest rate and just pay us 10%, right? That's balance transfer, right? You then, what you do is you use their check. They send you a balance transfer offer, usually, will come with the check. You by just using that check to pay off your old credit card company, right? How do you know how much you have? Of course, you know your balance. And for example, something like car loan, mortgage, we did amortization yesterday. We did amortization. So by doing the amortization schedule, you know what is your balance left. You just write that amount in the check, right? And your old credit card company will cash it. Then you're washing your hands. Your connection with old credit card company is severed. Old credit card company is your lender, old lender, and when you use the balance transfer check, the company that gave you that check becomes the new lender, right? You didn't use any of your money. You're just switching the lender from the old one to the new one. That's refinancing. And think about it. Call is exactly refinancing in bond. They call it, actually, in bond, they call it refunding. Okay? Rather than refinancing, they call it refunding. But what's the difference? It's the same thing. Refunding or refinancing, it's the same thing, right? It's the same thing. And when I asked a couple of years ago, I asked, to the students, and I asked, "Do you understand this concept of refunding?" And then someone said, "Yeah, you're refunding the money." I mean, yeah, I mean that's refunding. I want to get a refund on my, you return something to the shop store, and I want refund. That's refund. But also, in this case, you're funding, the company borrowed money to fund some project. Isn't that right? The company borrowed money to fund some project. Now, interest rate was so too high. You're not happy with that. Overall interest rate went down. This is a chance to refund your project. Refund your project, right? So that's that's why it's called refunding. Okay. So now that explains what call is. So if rates go down, right? But only the callable bonds are callable, and of course, I explained investors don't like calls because they lose a high interest rate. Issuers and investors compromise. Call provisions usually have call premium. Yes, that's the one more year coupon, right? Like penalty, early termination penalty. And there's a call protection period. Bond won't be called for a certain number of years. So here, let's take a look at the timeline. The life of the bond is 10 years, right? And now we are at year 2, at the end of year 2. We are at the end of year 2. And basically first 6 years is the call protection period. So for the first 6 years, they cannot call. Okay, and after that they can call. So when you value a call bond, the timeline is only up to the end of call protection period. You don't go all the way to the full maturity, because after that, you don't know what's going to happen, right? And then suppose interest rate didn't fall until the end of the maturity, until the end of the maturity, interest rate didn't fall. Then what's going to happen? It will not be exercised. Call won't be exercised. Okay, they will not exercise call. Call won't be exercised. And even if the interest rate goes down, for example, okay, year 7, year 8. Now, in year 9, let's say in year 9, during year 9, interest rate went down. With only 1 year left, interest rate went down. Is it going to be exercised? Is the call going to be exercised? No, it's not going to be exercised. Why? Suppose it went down, interest rate went down, so now you can refinance at 5%. Previously it was 10%. Now you save interest for only 1 year. You save interest for only 1 year, and it's only saving 5%. But then to exercise call, you have to pay 10% interest as call premium. Then think about it. You only save 5%, but you lost you already paid out, you paid out 10%. So then actually it is -5. Actually, your saving is -5%. Right? Makes sense? So as it's unlikely to happen as you approach maturity, as you approach the maturity, the call is not likely to happen. Okay, it's not likely to be exercised. All right, everyone, does that make sense?
Yes.
Yes, sir.
Okay, good. So here we have an exercise of a callable bond, and see, it has uh, to be retired anytime after the first. It can be retired, right? It can be, in other words, it can be called anytime after the first 10 years. So first 10 years, the call protection period, first 10 years. So if you value it, the callable bond, you use timeline only for the next 10 years until the end of the call protection. If it is normal, then the full timeline. So this exercise is not necessarily, it's not, crucial to do it now. I mean, you can do it later. Again, some people might ask, why is it negative? Why is the bond price negative? No, it doesn't mean it's not negative. It just means it's the cash outflow. Think about it. If you want to buy this bond, you have to pay. If you pay, it's a cash outflow from you. And at the end, you will get $1,000, and until maturity or until end of call protection period, the coupon payments are all cash inflows. So they are not in parentheses. They are not in red font because they are cash inflows, but these are cash outflows. So they are in red font and parentheses. Okay. Alrighty. So I guess the refunding decision. There are several. Things that you have to consider. You can just read it, right? So we have covered the call, right? How to value callable bonds. There are also puttable bond. If there's callable bond, there's puttable bond. But if call is if the call is the right to retire the bond, if the call is the right to retire the bond, what is the put? Put is the right to extend the maturity. So this is the right exercised by the bondholder. Put is the right to exercise by the bondholder, not by the bond issuer. Call is the right that can be exercised by the issuer, but the put is the right that can be exercised by the bondholder. So this is the case when they will exercise it when, if it is a puttable bond, they will exercise it when the interest rate goes down because they want to enjoy this superior return of 10%, superior interest of 10%, a little longer, right? Then they exercise put. All right. So we didn't have any break, so I think I can break it up a little early today. I will. Any questions so far? Any questions? Any questions? All righty. So then I will see you guys tomorrow, right? 12 o'clock. It's I don't know where you are, but New York area, it's a great weather today. Nice weather. Hope you'll have a great afternoon. I will see you guys tomorrow. All right. Thank you,
Thank you,
Kyle.
Professor.
Thank you, darling. Thank you, Yang. I will see you guys
Bye,
tomorrow.
Professor.
Take care, Leslyn. I will stop sharing and stop recording and sign out.